His investment account was always smaller than his brother's. His net worth was 5 times larger. The secret: he understood that concentration builds accounts. Diversification builds wealth. Most people confuse the two. That confusion keeps them poor. This is called the portfolio fragmentation principle. Your wealth is not one investment. It is a network of investments with different risk profiles. Most investors chase the highest return. They put everything in one opportunity. They build a single point of failure. When it fails, and it will, they lose everything. Strategic investors build uncorrelated positions. When one investment drops, another rises. They never bet everything on one outcome. They create a net with many threads. 3 threads break, 7 threads still hold. The net catches wealth that concentrated bets miss. This is not about being timid. This is about understanding that wealth survives shocks. Concentrated portfolios do not survive shocks. They explode spectacularly. Diversified portfolios absorb shocks and keep compounding. Same money invested, different structure. One structure gambles, the other structure builds. Let me show you what one day looks like for each approach and what that day becomes over 10 years. Dawn, 2 brothers wake in a coastal fishing village. Paulo and Rico, both 30 years old, both inherited 500,000 pesos from their father. Both want to grow this capital through investing. Today is investment day, their monthly ritual. How they spend this day will determine their decade. Paulo's day starts with conviction. He researches the single best opportunity. He reads forums, he watches videos. He analyzes charts. He identifies the winner. Today, it is a cryptocurrency with a revolutionary technology. He takes his 50,000 peso monthly investment and puts all of it into this one coin. He believes concentration creates wealth. If this 10x returns, he makes 500,000 pesos. Maximum upside requires maximum concentration. Rico's day starts differently. He does not look for the single best opportunity. He looks for 5 decent opportunities with different risk profiles. Today, he allocates his 50,000 peso monthly investment across 5 positions. 10,000 pesos to an index fund tracking Philippine stocks. 10,000 pesos to a bond fund. 10,000 pesos to a real estate investment trust. 10,000 pesos to an international index fund. 10,000 pesos to a commodity fund. He believes diversification protects wealth. None will 10x, but catastrophic loss is nearly impossible. By noon, Paulo feels excited. His concentrated bet is up 3% today. He checks the price constantly, imagines the 10x return. He calculates his future wealth. All eggs in one basket. All attention on that basket. By noon, Rico feels calm. His 5 positions move differently. Stocks up 1%, bonds flat, REIT down 0.5%, international up 0.8%, commodities up 1.2%. The net captured value from multiple directions. He checks his portfolio once, then goes about his day. The diversification removes the need for constant monitoring. Month 1 ends with similar returns. Paulo's concentrated position gained 8%. Rico's diversified portfolio gained 5%. Paulo feels validated. Concentration is winning. He gained 4,000 pesos. Rico gained 2,500 pesos. Paulo thinks Rico is playing it too safe. Year 1 brings the first shock. Paulo's concentrated cryptocurrency position crashes 60% in 1 month. The technology had a flaw. The price collapsed. His year-end portfolio value, 420,000 pesos. He lost 80,000 pesos. But he believes this is part of the game. Big losses precede big wins. He holds. He stays concentrated. Rico's diversified portfolio experienced the same month differently. His cryptocurrency allocation dropped 60%. But that was only 10% of his portfolio. Stocks rose 12%. His bonds stayed stable. His REIT rose 8%. His international fund rose 15%. His commodities dropped 5%. The net caught gains from multiple sources while limiting crash exposure. Year-end portfolio value, 570,000 pesos. He gained 70,000 pesos, while Paulo lost 80,000 pesos. The diversification absorbed the cryptocurrency crash. Year 3 brings bigger divergence. Paulo recovered from the Year 1 crash, then found another concentrated bet, small tech stock. He went all in again. That stock tripled. Felt like a genius. But then he bet everything on a real estate project. It failed. Construction never started. Total loss. Year 3 value, 480,000 pesos. He is still below his starting point after 3 years. The concentration created volatility without building wealth. Rico continued his 5-bucket diversification. Every month, same structure, different assets performing at different times. Stocks had a bad year too, but his bonds rose. His commodities spiked. His REIT paid steady dividends. The net kept catching. Year 3 value, 710,000 pesos. He gained 210,000 pesos while Paulo struggled to break even. The diversification compounded steadily without catastrophic losses. Year 5 brings the maturity test. Paulo changed his strategy 4 times. Each time he concentrated. Each time he encountered a shock, a pandemic, a market crash, a fraud, project failure. He is exhausted from the emotional swings. His portfolio touched 800,000 pesos once, then crashed to 300,000 pesos, currently at 520,000 pesos. 5 years invested, 20,000 peso gain total. The concentration prevented compounding. Every shock reset progress. Rico maintained his diversification. Same 5 buckets, rebalanced quarterly. When stocks crashed, he bought more stocks with gains from bonds. When commodities spiked, he sold commodities and bought stocks. The diversification created natural buying low and selling high. Year 5. Value, 920,000 pesos. He gained 420,000 pesos with 0 catastrophic losses. The net caught steady gains while avoiding deadly crashes. Year 10 delivers the final picture. Paulo is still searching for the concentrated bet that will make him wealthy. His portfolio has been as high as 1,200,000 pesos and as low as 200,000 pesos, currently at 680,000 pesos. 10 years invested, 180,000 peso gain total. The emotional exhaustion is worse than the financial result. He cannot sleep when positions move. He checks prices constantly. The concentration consumed his peace, along with his returns. Rico maintained his net for 10 years. Monthly investments. 5 buckets. Quarterly rebalancing, no drama, no panic. No checking prices daily. Year 10 value, 1,650,000 pesos. Gained 1,150,000 pesos with moderate stress. The diversification compounded steadily. No position failure destroyed the portfolio. When technology crashed, healthcare rose. When real estate struggled, commodities rallied. The net caught gains from multiple sources across a decade. Here's what happened beneath the numbers. Paulo optimized for maximum upside. Every position was a swing for the fences. This approach works on paper. In reality, it creates fragility. 1 failure wipes out 3 wins. The psychology of concentrated positions prevents long-term compounding. You panic, you switch, you chase, you reset. Rico optimized for minimum catastrophic loss. Every position was capped at 20% of portfolio. No single failure could destroy him. This approach looks timid on paper. In reality, it creates anti-fragility. Shocks strengthen the portfolio through rebalancing. The psychology of diversified positions enables long-term compounding. You stay calm, you hold. You rebalance, you compound. The math is brutal. Concentrated portfolios need perfect timing. Every bet must win. 1 catastrophic loss erases years of gains. Paulo proved this. His wins never compounded because losses kept resetting progress. Diversified portfolios need only average timing. Most bets can be mediocre. Catastrophic loss is mathematically impossible if you cap allocations. Rico proved this. His wins compounded because losses were contained. Check your own portfolio right now. What is your largest position? If it is more than 20% of your portfolio, you have concentration risk. That position failing will devastate you. You might recover, but recovery time is lost compounding time. Most investors think diversification dilutes returns. They are half right. Diversification dilutes maximum upside. Maximum upside is theoretical. Diversification also dilutes maximum downside. So maximum downside is real. It happens. Often, the trap is believing concentrated bets are how wealth is built. Concentrated bets are how dramatic stories are created. Wealth is built through avoiding catastrophic loss while capturing average gains consistently for decades. Boring wins. First, audit your current concentration. List every investment position. Calculate each as a percentage of total portfolio. Any position over 20%? You have deadly concentration. That position could end your wealth building. Second, build the 5-bucket structure. Bucket 1, domestic stocks or stock index. Bucket 2, bonds or stable income assets. Bucket 3, real estate exposure through REITs or property. Bucket 4, international exposure to reduce local market risk. Bucket 5, alternative assets like commodities or gold. Each bucket gets 20% maximum allocation. Third, implement monthly automatic investing. Do not try to time entries. Pick your 5 buckets. Invest equal amounts monthly. The diversification across time plus diversification across assets creates maximum shock absorption. Fourth, rebalance quarterly. When one bucket grows to 25% of portfolio, sell 5% and redistribute to underweight buckets. This forces selling high and buying low automatically. The structure does the work. Fifth, never exceed 20% in any single position. Ever. Not when something looks like a sure thing. Not when you have conviction. Not when everyone says it is the opportunity of a lifetime. Cap every position. This rule is non-negotiable if you want to survive long enough to compound. Month 1 of diversified investing feels like lost opportunity. Your concentrated friend brags about 15% gains. Your diversified portfolio gains 6%. You feel like you are losing. You are surviving. Year 3, your concentrated friend experienced 2 catastrophic losses. His portfolio is below starting value. Your diversified portfolio compounded steadily. You are ahead 40%. The diversification proved its value. Year 5, market crashes arrive. Your concentrated friend panics. His portfolio drops 60%. He sells at the bottom. Never recovers psychologically. Your diversified portfolio drops 25%. You rebalance. You buy stocks with bond gains. You recover within 18 months. The diversification enabled rational decisions. Year 10, you realize diversification was not about maximizing returns. It was about maximizing survival. Survival enabled compounding. Compounding created wealth. Your concentrated friend chased returns and found volatility. You built a net and caught wealth. 2 brothers, same inheritance, same investment period. One concentrated for maximum upside. One diversified for maximum survival. Concentration created drama. Diversification created wealth. The difference was structure, not skill. Next investment. 5 buckets. 20% maximum. Rebalance quarterly. Build the net. Start Monday. More frameworks ahead.